Today's episode is sponsored by Future State Media, experts in off-Amazon traffic for Amazon sellers. Future State Media will build you a custom-made website to deliver sales for you on Amazon. Built to grab traffic from search engines and social media, your site can be used as a secret weapon for launching products on Amazon or just to stabilize your Amazon sales. It means you can also build an email list on autopilot. Go to futurestatemedia.com for your free guide to Google SEO for Amazon sellers today. Ladies and gentlemen, boys and girls, this is Michael Veazey from the 10K Collective and Amazing FBA podcast. Today we've got a lovely guest with us called Terry Lammers. Lammers as rhymes and hammers, just checking how it was pronounced before the show. And he's from Innovative Business Advisors. So Terry is a very, very experienced entrepreneur and these days helps people buy and sell businesses. As part of that, he helps value businesses, and also he's got a great coaching program called CEO to CEO, which is confusing sounding until you realize it stands for Chief Everything Officer to Chief Operating Officer, which I so really nicely put. You've got me nailed with that program statement for starters. So Terry, warm welcome to the show.
Thank you. It's great to be on.
Good to have you on. So I know that you're busy promoting your book, You Don't Know What You Don't Know, which is a really smart title. So we'll talk about that specifically. But first of all, we've had a few guests on talk about business valuation, and it's sort of a hot topic amongst Amazon sellers. But the first thing is we're going to focus on accuracy and the valuation of your company. So let's assume that you are, for the moment, a business owner, which I guess is a majority of people who are listening to the podcast who own any kind of Amazon business are going to be the owners rather than considering buying at the moment. What would you say are the classic errors that people make in this area?
Really the classic one, and it's most frustrating for me, is people that overvalue a business. We've actually trademarked a term called the bankability method. So I hang my hat on that quite a bit when we're valuing companies that have less than $1 million a year in cash flow. So if I tell you your company's worth $1 million, can you go to a bank, make a reasonable down payment, and pay for the company within 5 years, which is typical amortization period for buying a company? You need to have enough cash flow from that company to pay yourself a fair salary and meet a debt service coverage ratio that's acceptable to the bank.
So it's a sort of acid test of the value of your bank. If you think this business is worth that much, will a bank agree with your assessment, broadly speaking?
Exactly.
Okay. And this is based on a sort of 5-year cash flowing, more or less.
Yes.
Okay.
Back in the day when I was buying companies, that was kind of my trigger point. If you could pay for a company in 3 to 5 years, that's when, we've got a deal, and it's going to fly with the banks. So, you'll have a bankable deal.
Bankable deal. Great. So I think you're approaching things from quite a sort of unique perspective already compared to the other valuation experts I've spoken to. And that's the main deal for the buyers as well. So tell me a bit more about the buyer perspective then. How can I put this? I guess from the seller's perspective, but what do we need to think about with the buyers when we are valuing a company?
The most important thing for the seller is to have accurate financial statements. I mean, that's really the face of your company. There's, other reasons that a buyer may want to buy your company, but the main part of the value of the company is going to come from the cash flow of the company. So it's very important that you have readable and relevant financial statements. And when we're valuing the company, we want to go through a process, what we call normalizing the financial statements. So we want to get to the true cash flow of the company. And the simple part of that is adding back depreciation and amortization, which, kind of gets you to EBITDA. And then you're going to add back the owner's salary, which gets you to seller's discretionary earnings. The way I like to explain seller's discretionary earnings is that is all the earnings from the company that the seller has the discretion of spending, whether they're paying themselves a salary, rent for a building, or loan payments, or, but that's all the income from the company. The other important thing is to normalize things like the owner's salary. Sometimes we'll value a company and the owner's not paying themselves anything. So we will subtract from the cash flow of the company a fair salary. Other situations you see is where the owner's paying themselves an excessive salary, say like $300,000. I don't know what that comes out to in pounds, but if a normal salary is 100,000 and they're paying themselves 300,000, we want to add that extra 200,000 back into the cash flow of the company. Another important thing for the seller to keep in mind is if you are taking personal, if you have personal expenses in your company that the future buyer wouldn't have, it's very important to be able to really show an accurate number of what that is. So say you got cell phone bills or something like that, put them in a separate line item that you can come up with the invoices to show specifically those bills. What doesn't go over with buyers is when you have an item, say we got $10,000 for phone expense, and you say, well, about $3,000 of that is personal. It's much better if you have, if you can correlate that cost to an invoice.
Okay, so I guess it comes down to sort of a few things. Well, I've got some questions, and we used a few abbreviations. I've got a rule on the podcast that I always crack open every single abbreviation. So we'll get into that in a second. But first of all, I guess what you're saying is you need to have some kind of very formal relationship between the business owner and the company or the business you're selling as a separate entity, right? Which I guess is one of those things it's almost impossible to do if you don't make a conscious effort for it. So if you're expecting the business to pay some of your phone bill, you invoice the company for that money, right?
Correct.
Just simple things. Okay, good. So it comes down to cleaning up the records. So let's go back to normalizing the statements. We just threw a few big words around. You explained what seller discretionary earnings were. We threw around the words depreciation, appreciation, and amortization. Sorry, I think I've got that completely wrong. So what? I know I'm not saying you're an accountant, but obviously we're using a lot of accounting terms, which is very interesting that you focus very strongly on accounting as the sort of main value builder for a business. So what is first of all EBITDA? I believe it stands for earnings before interest, tax, depreciation, and amortization. Is that correct?
Correct.
So is that roughly? First question then, is that roughly the same as pre-tax profit?
No.
Okay, so tell me the difference.
Yeah, so I have one of my main things is I always tell people your company is not about sales and net income, it's about gross profit and cash flow. So we're trying to get to the true cash flow of the company. So EBITDA, earnings before interest, taxes, depreciation, amortization, that is really the true cash flow of the company. Depreciation is a non-cash expense that you use to write down assets that are on your balance sheet. So that's why you add depreciation and amortization back to your net income to get to the true cash flow of the company.
So tell me a bit about this, because my understanding, I mean, humor me if this sounds like baby stuff, but depreciation is, for example, if I buy a computer that cost me say $1,000, like an expensive computer. My computer actually cost me like $2,500, which I'm kind of regretting now. But let's say it's $1,000, and you do straight line depreciation. That means okay, you think it's going to die in 5 years, so it's going to be a value each year. You're going to take a fifth off the value, and after 5 years, it goes to zero. That's roughly speaking, okay, good. So we call it straight line depreciation, as I understand. I'm not an accountant. Yep. Don't sue me if you get this wrong, guys. So getting an accountant is absolutely critical. You get a good accountant, which I think is emerging from this.
States, you have bonus depreciation. So say you bought a truck that's worth $300,000, you can depreciate $250,000. I believe that's the right number, somewhere in that ballpark. But you can take a large chunk of depreciation in 1 year. Well, that's very negatively going to affect your net income, but that's a non-cash expense. So you really do you got to add that back to the net income to get to the true cash flow of the company.
Now, this is where I get confused, and this is why it's interesting that we're plunging into the details of accounting here. And I guess you're really pointing us strongly that direction. So, so it's on your head, all this accounting stuff now. When you said the true cash flow, my understanding is that if I, for example, own a load of stock, and let's say I'm selling chocolates, which is probably a stupid idea, and they have a sell, but let's say more realistic, you're selling some face cream or something on Amazon, and in 12 months time it goes out of date and you're no longer allowed to sell it. So you've got a 12-month, I guess after 12 months the value goes to zero, right? So you've got a 12-month depreciation on that. Now, if I sold that, I would convert the value of that stock into pounds or dollars, and if I don't sell it, it goes to eventually zero. But in what way is the depreciation in the value of that stock? how is that related to cash flow? Because for me, if I own, say, my computer and it's worth a fifth as much in 5 years' time, it hasn't actually changed my cash flow unless I have to buy a new computer, right? Or what am I missing here?
No, it doesn't. I mean, you're just, that depreciation expense is just hitting the, um, just hitting your so it's lower. The depreciation is to lower your net income so you don't have to pay as much taxes on it. But
Okay.
what you was kind of talking about, you bring up another very interesting thing, and I get asked this question all the time, is what do you do with the equipment of the company? So is it the value of the company plus the equipment? So here's the way I would like your listeners to think about that. You purchase equipment such as your computer, or maybe it's a machine or a truck or whatever. As a business owner, you purchase equipment to create cash flow. That cash flow has a value, and that's what we're valuing. So if the value of that cash flow exceeds the market value of the equipment, you have goodwill in the company. If the value of that cash flow is less than the market value of the equipment, there's no value to the business, and you would just have an asset sale. Does that make sense?
I think so, but could you give us a concrete example?
Yeah. So I see this a lot with excavating companies, especially because, they've got bulldozers and scrapers and, just a lot of heavy equipment and then what I guess is important is, you talked about depreciating your computer off. Well, that's a book value. That's what, that computer is on your balance sheet as a book value. That doesn't represent the market value of that computer. Even if you wrote the thing off in 5 years, and it has a book value of zero because you depreciated it off, it probably still has a little bit of a market value that if you want to sell it, over Amazon or something like that. So if you're an excavator and you've depreciated all this equipment down, but there's still a demand for it, a market value, that's where if the value, if the the cash flow from the company, say you're just using a multiple of 4. So if you're if you're only cash flowing $50,000 a year, you're only making $50,000, and the multiple is $200,000, but the equipment's worth $500,000. Well, there's really no value to the company. You're just going to sell the equipment
Okay, so
and
that's what they call an
cash that way.
asset sale, right? Okay,
Yeah,
interesting. I suppose it's what they call selling the business as in the British term is a going concern. So it's making money in some way versus
yeah.
you're just splitting
And
it up. And if you've got an excavating company, you sell off the bulldozers and I don't know dynamite or whatever else they have.
it,
Um,
so there
okay,
is no going concern. You see an asset sale a lot when a company's gone out of business,
yeah,
or if it's just flat not making any money.
yeah.
So if the company as a going concern is very healthy and making a strong profit, then likely the value of that cash flow is greater than the assets of the company.
Okay, cool. So let's get on to because very few people I think who sell. There are some people who make stuff. I do know one person who makes their own sort of face creams at the kitchen table. So I guess the kitchen
Yeah.
table is a very mildly not very expensive asset. So I guess that's probably not going to be a big thing. So what are the other things that we need to normalize? And you talked about the owner's salary. Tell me a bit more about that because that's probably going to be more significant than most of us don't own excavating equipment in the e-commerce world.
Yeah. Well, it is important. I had a web marketing company that we just valued, and the lady wanted to sell, and the company's cash flowing, roughly $120,000 a year.
Hmm.
So, but she's not paying herself any salary. So, when we go to value that company, if I'm going to buy that company, I want to pay myself something. I'm not just going to do it just for fun, right? So, what's a fair salary? So, here in the United States, we can go to the Bureau of Labor Statistics and pull, what would be a normal salary for somebody in that industry. But let's just assume it's $60,000. So, if the company's cash flowing $110,000, but I pull a $60,000 salary out of there because she's not paying herself. Now there's really only $50,000 left that would be available to pay for debt or anything like that. So it really diminishes, the value of that company. It reduces the cash flow.
Okay, so basically we are looking at the value of the company being a multiple of the profits once you've taken the owner's salary out. Is that right?
Yes. Yep.
Okay.
Perfect.
So
Perfect.
tell me what this owner's
So,
discretionary earnings then. How does because it's a phrase you hear around a lot once you talk about business selling, and people are always using it. But or sorry, seller discretionary earnings.
yeah.
What?
So
Tell me about that.
you start. So really, in this example, the seller's discretionary earnings was the $110,000, and then once you take out a fair salary, then what's left is your EBITDA, earnings before interest, taxes, depreciation, and amortization.
Okay.
So that's what you're really going to use to value the company.
Okay. So the seller discretionary earnings don't get sort of bundled back into the valuation of the company then.
Not really. No.
Okay. Well, that does make sense to me. It's funny
Yeah.
because you hear different things. I mean, sometimes people say you can bundle those things back in, and sometimes not. I mean, so yeah, it's the question is which
You,
number we're using to value,
right.
the
Valuations can
company.
be tricky. I mean, it's as much
Yeah.
as an art as it is a science. And there may be somebody listening that would disagree with me. But,
Hmm.
think about it. If you're going to buy a company, don't you want to pay yourself? You got to live off of something. So,
Yeah.
it, you know, it, it makes sense, right?
It does make
So,
sense to account for the owner salary 100%. What I'm
yeah.
interested in is the valuation metric, I suppose, that
And
typically.
really, you can think about it from the flip side also.
Hmm.
What if the person was paying themselves $300,000 a year in a salary? So that's greatly going to reduce their EBITDA. But if a normalized salary is 100,000, then you want to add back to cash flow that extra $200,000 a year.
Okay, that does make sense. So one, this sounds like a dumb question. It probably means it's important to ask it. I've learned over the years. Um, so the value of a company is a funny thing, isn't it? When you're looking at selling it to somebody who maybe if it's a smallish business, $1 million valuation or so, and you're not selling it to a hedge fund or not going to be a hedge fund at that level, but private equity, which I know roll up businesses, and or a strategic valuation, which I know is a different thing that we're going to talk about, i.e. one of your competitors buys you for different reasons. But let's assume that I sell an Amazon business. It's doing, let's put some numbers on it as a concrete example. This should help us sort this out. It's got $50,000 a profit a year, and I'm paying myself $50,000 a year as the managing director of it, or the CEO, if you like. And I want to sell it to a retired doctor as part of his sort of portfolio of income streams and what have you, assets. So I guess that guy has two ways of looking at the value of it, right? One is that he can pay him an income stream should he choose to employ somebody else to manage it, and the other one is that he can enjoy managing it himself. So which one of those numbers, or is it both, does the company get valued on?
I mean, I think it's important that you take that. You just got to have a fair salary in there, whether whether it's for the manager or if the owner's managing the company himself. That's where we start to talk about the difference between a financial valuation and a strategic valuation. When I'm doing valuations of a current company, I'm valuing their current cash flow. So I tell people I'm doing a financial valuation. I'm valuing the current cash flow of the business. If I'm a buyer and I know I can eliminate certain operating expenses and things like that, there may be a strategic value to me for buying this company that's really hard for me as a valuator to figure in. I don't, and that's where it starts to get complicated. I look at the sale of my business and it's sold, you know, for a pretty large multiple compared to how I would normally value a company. But my business was a very strategic purchase for my buyer because they was eliminating somebody that I was a strong competitor in their market, and I had a lot of assets that they needed as far as a lubricants blending facility and things like that. So when I'm valuing a company, I'm valuing the current cash flow of the company. It's a financial valuation. You may get lucky and have even a small business that a very larger business could say, wow, that guy really invented something pretty neat here. And we can spread that across, you know, the world and sell a gazillion things. So it is interesting.
Yeah. Okay. Well, look, the strategic valuation thing interests me a great deal. But before we get into that in detail, can I just come back to my maybe rubbishy little example? Okay. So it's doing $1 million a year business. I'm making 50,000 profit after the salary, which is $50,000. What value would you place on that business? Let's assume that it's the standard multiple. Or before we even look at the multiple, let's talk about which number do we start with as the
Yeah, so
thing we
you're gonna
multiply.
start with that $50,000, and for a company that small, you're usually gonna be in a 3 to 4 multiple range. I'd say it would be a good fair number, 3 to 4 times cash flow.
Okay. So
And
you're
and
going to
the
be
larger your
yeah.
businesses get, the higher the multiples you're gonna see.
Okay, well, that's an interesting other thing as well. So we'll talk about that in a sec. So in this little example, so I'm paying myself $50,000 as the manager of the business as I own it. If I want to sell it, I can sell it for roughly speaking, whatever the multiplier is, 3 times, 4 times the $50,000 profit slash cash flow, right? So the owner's salary is the salary of the manager. Then is just basically sees an expense in the business like anything else, right?
Yes, correct.
Okay. I mean, it makes total sense to me. I just wanted to thrash
Yeah.
that out because people throw the word seller discretionary earnings around, and then suddenly it seems like you can produce magic and sell you a company for more than it profits. But you're telling me that common sense still applies. It's a multiple of actual profit. All right,
Yes.
great. So, tell me a bit more about the multiple then. The strategic valuation thing we'll talk about separately, I think, because that's obviously a rarer but very valuable situation and possibly one worth engineering from the outset if one can, I guess. But tell me about the multiple. You're saying 3 to 4x. I mean, my understanding of Amazon-based type businesses, they typically sell between about 2 to 3 times the cash flow. I guess that's based on defensibility, but what are the factors that will multiply the what is the even the word we use, multiplier? What is it, multiple? What's the word we
A
use?
multiple, and it could be a
Yeah.
multiple of a number of things. It could be a percentage of sales. It could be a multiple of EBITDA. Maybe it really there's really no set thing that it has to be a multiple of. And in our theory, of coming up with a bankable deal, will a bank lend on it? Is there enough cash flow to make the payment to pay for the company? You're coming up with the value doing, you know, our bankability method, which gets you to a fair debt service coverage ratio. And, you come up with a value that way. And then you kind of really back it into what is that value of, if I divide it by EBITDA and it's 3 times EBITDA, well, then it's a multiple of 3 of the EBITDA.
Okay. Okay, but it
If
comes
that
down to like,
value is equal to 80% of the sales, well, then that value comes out to 80% of the sales. Kind
okay.
of, it will vary depending on the company.
So it comes down to that kind of acid test of would a bank, and I guess that and then it's going to vary, right? But the standard sort of bank based on normal ratios and things lend to
Yeah.
you. So, okay, we'll have to dig into we have to dig into bankability as well in a second because you keep bringing that up and that sounds intriguing to me. Just before we do that, then, what? So okay, we're gonna have to dig into it right now because you just said to me, okay, the multiple is just a kind of artificial thing in a way, so it comes down to bankability. So okay, let's dig into this. Let's take an example because I think that really helps with this stuff. Otherwise, we're dealing with acronyms like
Yeah.
EBITDA
Well,
and things like that.
so if you go to borrow money, so there's a chapter in my book on bankability, and the basics of any loan is collateral and cash flow. So if I borrow money from you from the bank, what type of collateral are you going to give me that I can, put a lien on, so if you don't pay me back, I can take to make myself whole? And then the other side is cash flow. Is there enough income coming from the company to pay back the bank for the money that you borrowed? Most banks here in the US have a minimum debt service coverage ratio of 1.25. So that means there's $1.25 in income for every dollar's worth of debt. In my opinion, that's still a very low debt service coverage ratio. I like to see around 1.7, $1.70 in income for every dollar's worth of debt. So, when we're looking, and then, you know, most of the time when you're buying a business, there's not a lot of equipment. Even if, there is equipment there, the bank's going to discount it from a collateral standpoint. So that's why it's important to figure an amortization rate, how long is it going to take you to pay that loan back? And I typically use 5 years. So what's the income coming from the company to pay that note back in 5 years and have a debt service coverage ratio of around 1.7? Now,
Okay.
that's probably, I hope that doesn't sound overcomplicated to your listeners, but it really is important. I guarantee you, if you had bankers listening, they would appreciate that very much.
100%. And what's interesting about what you're saying is that this doesn't seem to just apply when you're trying to sell a business, because I know there's one of the businesses in the mastermind that I run in London, which has doubled its sales twice since I've joined us. So they doubled it each year for 2 years in a row, which is obviously amazing from the sales and market share point of view. But of course, it creates a monstrous capital problem. So they are borrowing a lot of money. So they're having to become very fluent in thinking about things from a banking perspective. And again, I was speaking to somebody else the other day about company valuation. It seems to be the season for talking to people about this. But again, business valuation really has to be based on a sort of objective criteria. And he was also
Yeah.
talking about the balance sheet and the financial documentation and what you can read from it. And eventually you end up in the realms of accountants and banks, whichever
Yeah.
way you
Well,
crunch it, right?
yeah. So you bring up an interesting thing. So they doubled the sales of the company, but did they double their gross profit? And that's really something that we get into with our CEO to CEO program, and getting owners to really understand the cash flow of their business. Because if depending on, looking at your accounts receivable days, how long does it take you to collect your money? Your accounts payable days, how quickly are you paying your bills? Or your inventory days, how quickly are you turning your inventory? So in my situation, when I owned the oil company, my accounts receivable days was 27. So I was collecting my money from the time I sold it in 27 days. But you have to pay for fuel in 10 days. So overall, my accounts payable days were 12. So you see the gap there? There's a 15-day gap. So if my sales are $100,000 a day, I'm going to have $1.5 million in working capital that I need to fund my payables before I start receiving my money. So you said your sales double. Well, if my sales go from $100,000 a day to $200,000 a day, to cover that same 15-day spread is now $3 million. But that has nothing to do with the cash flow of the company. That's just cash that got sucked up in your company to support your accounts receivable. Same way, if all of a sudden your inventory days jump up a lot, then that's money that's stuck in inventory. It doesn't have anything to do with the profitability of the company.
Okay, so I guess what we're coming to is that really critical difference, I believe, in a capital intensive business, particularly a sort of stock based business like
Sure.
e-commerce, for sure, that the difference between cash flow and profit. I mean, when I say cash
Yes.
flow, I suppose I'm talking the conventional sense of cash movements in and out of your bank accounts, rather than any more complex use of the word cash flow. And then the profit and loss, I guess, is, as I understand it, simply the difference in the equity value of a company at the beginning and end of a period. So actually, you could, in
Yep.
theory, have no cash go in and out of your business, and from depreciation lose money or something like that. Not that that would be normal for such an active business model,
No,
but
but but it is known. It's more normal than you think, especially here in the United States, because you have
Mm,
bonus depreciation. So I
hmm
mean, if you're allowed to write off $250,000, so I see examples all the time where the owner kind of comes to you with this sheepish look because they have a very low net income, but when you add back the depreciation and everything, they're actually cash flowing very nicely. But then likewise, you go back to talking about how cash moves in and out of a company. You can go broke not because you had an unprofitable company, but simply because you ran out of cash. I mean, and that can be a real problem, especially when you have a company with large accounts receivables.
Yeah, 100%. I mean, I think for me, the number one thing I look at now when I'm trying to help someone, it's funny because I was just going through a process of trying to do cash flow projections in a rather
Mm-hmm.
broad picture scale, which is always very dangerous because the detail is where the problems come. But I was trying to help somebody who's a very experienced business owner transition into an e-commerce type business, and what I'm trying to get across is that it's all about never running out of cash, which is kind of obvious to anybody, but when you've been working in they've been doing digital marketing type business where they have big overheads, spent like hundreds of thousands of dollars on creating a sort of proprietary database system, and they've got good staff and stuff. But once you built it, then each sale does not cost you very much after that. Whereas the
Correct.
cost of goods sold with e-commerce is frighteningly large, just like with property or real estate investments.
Yeah,
You always have a lot of capital costs in each and every transaction, I guess. So the cash flow side of it, I think, is so critical, which is why I'm always
it is.
digging into
Well,
the meaning of the word cash flow whenever I talk to
hmm
financial experts like
so
yourself.
another thing for your listeners to think about, especially if you're going to be a buyer, is when you buy a company, in essence, you're writing two checks. You're writing one check for the value of the company, but then you're going to have money, which is kind of your second check, to be for the working capital to operate that company. So that's why there is a little bit when we talk about non-financial things that can affect the value of a company. I mean, this is financial, but theoretically, the higher your working capital needs for the company could lower the amount, the value of the company, because your buyer may be struggling to come up with enough money to buy the company, and it's all about now I need another $500,000 to support accounts receivable and inventory and stuff like that.
Mm.
So it may inhibit their ability to buy the company.
That makes a lot of sense. So I guess that's probably naturally going to bring us to the other things. We've got several other topics, all of which are pretty fascinating, and I think are really important for serious business owners, which is comes down to being a better CEO and raising the value of your company. And I think that the financial side of things, particularly things like working capital, which again is a phrase that gets bandied around sometimes and people mean very different things by it. I think that's going to be a very important thing to dig into. So we're going to move on to that on our next episode, I think. But any final things to say, well, I'll say final, in the very superficial level about getting an accurate valuation of a company?
Yeah,
Any other
you,
particular things we need to cover
we
there?
really dug into the nuts and bolts of it, but at the end of the day, I think it's very important for any business owner, no matter where they're at in the life cycle of their business, to have a business valuation. You need to have a realistic expectation of what that company's worth. There's a statistic out there, and it was very true with me, that for most business owners, the value of their company represents like 85% of their net worth. So, one, if you're planning on the sale of that business to fund your retirement, what I see is tragic is when a business owner will go to a financial advisor and tell them that their company is worth, let's just say, $5 million. So then the financial advisor won't question it, and will write up a retirement plan as if someday this $5 million check is going to come in. Well, fast forward to when the owner's 65, 68, and they find their way to somebody like me to help them sell their business. And we then tell them that their company is worth $2.5 million. And oh, by the way, that's before any income taxes or anything like that. It completely destroys their retirement plans. So if you're a business owner, I don't care if it's 10 years until you plan on retiring, you need to have your business valued so that you have a realistic expectation of what you're going to be able to sell that for. And then, you need to take that number and work. It's all about building your team, right? So go to your financial advisor and figure out what am I going to need to retire? So if I do need $5 million to retire and the company's only worth $2.5 million right now, well, then we need to grow that company to get it to where it meets your retirement needs. So that, besides all the nuts and bolts of how you do the valuation, you know, that is a glaring reason to get a business valuation done.
And by the way, thank you. So excellent advice. And again, I guess people would say this. It's obvious thing that a business valuer and a business buyer and seller, or somebody who helps people with that, would say it's important to value your business. But I would second the fact that I think that's incredibly critical. Apart from anything else, the more I speak with people about this process, the more it helps to shine a bit like my new lighting that I was telling you about. That I've got, it shines a rather glaring light on
Yeah.
things, and you very quickly see flaws that you would just kid yourself about, or that you just even wouldn't be aware of
Yeah.
ever if you
So,
didn't have that evaluation by an
right.
outside person, that objective look, right?
So another very important thing for listeners to think about: when you're, when we're valuing a company, we want to look at several years worth of data, 3 to 5 years. And what's really important is to look at that cash flow trend. What's the company doing? Is it, let's just say, if you looked at the last 3 years, did it make $200,000 one year, 225 the next year, 250 the next year? So you have a real close range. Or is it a deal that I made $100,000 this year, $200,000 the next year, and $300,000 the next year? Now you've got a really steep trend, and you may value the future cash flow of the company. Or, sad to say, what we see quite often, I call it the glider path. The owner took his foot off the gas 5 years ago, and the thing's gone from making 500,000 to 450 to 400 to 350. So what's the next year going to be? Is it going to be 250? It's not really fair to use an average when you have a sharp decline or a sharp increase. So what you're really trying to do with a valuation is predict the future cash flow of the company and what the value of that cash flow is. But that's where I see some valuators, in my opinion, overvalue a company. They'll use what's called a discounted future cash flow method, where they put a growth rate on the company, as if it's going to grow for this 5% forever. And if the average cash flow was 300,000, then all of a sudden they're valuing the company off of $500,000 in cash flow, which the company never achieved. So I hope that wasn't all too confusing. The
Well, I
main
mean, it
thing
may
there
be
is
for some
income
people.
trend.
I think what you're saying is the trend. What you're trying to do, I think it's a lot of common sense. The purpose of valuing a company is to predict the future cash flows, I think. But what you're saying is that discounted cash flow thing probably works very well if you've got a very stable asset like treasury bonds or gilts. I say stable. I mean, we're in a world of printing so much money that may not be true anymore either. But traditionally, you would buy gilts, which is 10-year bonds from the UK government, or treasuries, which is 10-year bonds from the US government, and they'd be paying whatever 2%, 3% interest, and you could probably predict fairly well what the cash flow was going to be in the future and what the value of it was. But these days, yeah, that's not maybe the case. But you're right. You have to allow for the what I call the bucking bronco nature of something like Amazon, particularly that there is a lot of variability and there are some sharp trends. I mean, if somebody's doubled the value of their business twice in 2 years, then I don't think I'd want on this business being around for generations. I wouldn't want to value it on the basis of the last 20 years average, because that would give a very inaccurately low valuation. So common sense tells you that what you're saying makes total sense. I wouldn't buy it. I wouldn't buy a
It's a,
business like that.
it's
Like that.
funny though. It's amazing how common sense goes out of the window on a lot of these valuations.
It is. I think. Yeah. I think in the end, what you got to realize is that I'm going to put this. This is my sort of 2 cents for what it's worth, or 4 penneth, as we say in UK. That in the end, figures are really important to understand, to read properly. And God knows I have a lot of way to go on that way, and a lot of
Yeah.
people do as well. But they are a proxy for value, because in the end, value is what somebody's prepared to pay for something. I mean, it doesn't matter whether you think it's a little Amazon widget worth $20 or whether it's a $20 million
Yeah.
business. In
It,
the end, it's worth what somebody's prepared to pay, right? So
Yeah, it's funny. In every valuation that we do here, so in Illinois or in the United States, you have IRS, the Internal Revenue Service. So
mm,
there's an IRS ruling 59-60, and it basically says that your company is worth what somebody's willing to pay you for it and what you're willing to sell it for, with
yeah,
both parties having relevant information about the company. So, at the end of the day, whatever I tell you it is in a valuation, that's what it boils down to. It's worth what somebody's willing to pay you for it and what you're willing to sell it for.
yeah,
So, but another, again, to bring up the team concept, and another one of my mantras, the first one is it's not about sales and net income, it's about gross profit and cash flow. The second one is it's not about what you sell your company for, it's what you get to keep net of taxes. And that's a very important thing. So, if I tell you your company's worth $5 million, but you don't, depending, that's where your attorney comes in, and that's why you want to use somebody that is familiar with mergers and acquisitions to help you um, facilitate the sale of the company in the best way that helps you from a tax benefit. And there's all kinds of different vehicles for that. So um, one of the things most owners want to do, what does an owner want when he sells his company? He wants that big check, right? But that big check comes along with a big tax bill. So that's why it's very important to work with a tax professional in the sale of your company to make sure you can keep as much as possible from the sale of the company. Does that make sense?
Absolutely, and this is where a lot of people, entrepreneurs, rightly wary of self-proclaimed experts when it comes to guru types and saying just do this and you'll make millions from this business model. But when it comes to specific things like business valuation, accounting, and tax law, and of course the legal side of it, then yeah, this is the time to really have the experts on speed dial, isn't it? So 100% agree with that. Talking of which, neatly, I'm gonna force us to close this episode down because I want to open another one up, which is the CEO to CEO idea. So go from chief everything officer to chief executive officer, and because I really think that is where, as you were saying, there's a gap between what you want the value or need the value to be and where it is, where the leverage is. But just to say, if you want to learn more from Terry, there's the book out, which we'll put an Amazon link at in the blog, which is at 10kcollective.com, and we are going to put a link in there. But the book is You Don't Know What You Don't Know, which is obviously, as you can tell from our discussion today, a blend of some quite complex stuff, but also some simple home truths, which I think is great. We need to get the detail, but we need to put it in context as well and what really matters. And then also if you want to get I guess, relative to working with you guys, a superficial valuation of a business as a buyer or a seller, you could go to amazingfba.com/value, VALUE, and there that will link through to the business valuation services that Terry has as well. So innovativeba.com is the website if you want to visit it. And the last thing I just want to say is thank you for, by implication, flagging up the idea that we should have some kind of financial plan for retirement, because a lot of people don't. And if you don't, you need to you need to have one, but also you need to include your company in that in an accurate way. So that brings us to the end of this episode. In the next episode, we're going to be talking about that chestnut of how do you make your business worth more by becoming a better CEO, which I think is an excellent blend of things. So thank you very much, Terry, for coming on and sharing your wisdom about valuing a company.
I appreciate it very much. It was great to be on.